Welcome to our today's revision session of Advanced Public Finance and Taxation, and we are looking at question number 4 of November 2015. We will go through the question, and the question reads as follows. Riggs Drilling Limited is a mining company dealing with petroleum products. During the year ended 1st December 2014, the following details were extracted from the company's financial statements. The figures are in thousands. Geological costs, 84,680,000. Exploration drilling costs, 146,400. Acquisition costs, 19,800. Lifting costs, 12,600. Lease operating costs, 64,780,000. Cost of refining crude oil, 18,240. Oil and natural gas revenue, 9,840,000. Depreciation and depreciation, 34,980,000. Share-based compensation, 24,670. General and administration expenses, 78,340,000. Reversal of litigation expenses, 9,680, sorry. Finance expenses, 6,400. Decommissioning costs, 4,280. Drilling machine, 18,300. Investment income, 464,000. Impairment losses, 5,680. Intangible drilling costs, 3,420. Professional fees, 2,600. Loan repayment, 840,000. Derivatives oil losses, 480,000. Restructuring expenses, 848,000. Sorry, 848, the figures are in thousands. Forklift, 1,800. Additional information. Number 1, intangible drilling cost includes shillings 420,000 for a well which failed to yield crude oil and was abandoned. So this is a well which failed to yield crude oil and was abandoned. Number 2, restructuring expenses includes shillings 582,000 paid to a consultancy firm that restructured the capital structure of the company. Number 3, exploratory drilling costs includes plant and machinery, shillings 4.8 million, erection of rigs and tankage, shillings 1.6 million, pipes and storage tanks, 9,480,000. We have a factory building of 48,400,000. Number 4, professional fees includes shillings 800,000 for services provided by the general manager of the parent company. Required, a statement showing the taxable profit or a loss for the year ended 31st December 2014. Statement showing the taxable profit or loss for the year ended 31st December 2014. Now, we will go through the items one by one, explaining their treatment in terms of whether they are allowable or not allowable. Remember, for us to get the taxable profit or loss, we are going to consider the income or the revenue of this company, which is mainly the disposal proceeds of the petroleum products and any other investment income. And then we shall consider the expenses that are incurred in this operation. Now, the guidelines for knowing or determining the taxable income is included in the Income Tax Act, the 9th schedule. So most of the things that we will be saying in this case are the guidelines obtained from the 9th schedule to the Income Tax Act, which deals with the petroleum companies. Now, item number 1 on the expenditure is the geological costs. The geological cost is an allowable expenditure. We also have the exploratory drilling costs. These drilling costs are also allowable for the tax purpose. We have the acquisition costs. These are the costs incurred in acquiring the patent rights to the mines, and in this case, they are also allowable, but we allow only 20% of this acquisition cost, since the acquisition costs are classified as a qualifying expenditure. And normally the qualifying expenditure, we allow 20% of it. We have the lifting cost or the hauling cost. These lifting costs are basically the cost of bringing the petroleum products to the service. Remember, the petroleum products are underground and they have to be brought to the service. So we have the lifting cost or the hauling cost. So these costs are also allowable. Then we have the lease operating costs. The lease operating costs are also allowable expenditure. Then we have the cost of refining the crude oil. This cost of refining the crude oil are also allowable expenditure. The oil and natural gas revenue, that's an item of income which we earn. We have the depreciation and the depreciation. This is not allowable generally, the way we treat the depreciation. The depreciation is generally not allowable, so the same thing we shall do here, including the depreciation. Then we have the share-based compensation that we shall ignore for purposes of computing our taxable income. Then we have the general and administration expenses. Basically, that is an allowable expense, so we shall allow that. The reversal of litigation expenses. So these ones, we shall include this one as we shall add it to our income, because here we are told it's a reversal of litigation expenses. So we will assume that these litigation expenses had been allowed somewhere, had been allowed maybe in the previous years, and since it is a reversal, so we shall treat it as an addition to our revenue. Then we have the finance expenses. The finance expenses is a usual cost for the businesses. Businesses operate with finances, so the interest, the finance expenses, and any others are a proper allowable expense for the business. We have the decommissioning cost. The decommission costs, these are basically the costs of officially stopping the operations. So when an operation stops, there are costs that are related with that, and then these costs are also allowable. So the decommissioning costs basically officially the expenses officially incurred to stop an operation, e.g. an operation like this, which is the drilling. Then we have the investment income that we shall add to our revenue from the oil products and add it there as other incomes that we shall bring as other incomes. Then we have the impairment losses. The impairment losses, this is the loss of value, basically the loss of value perhaps of assets, and this one we will not allow because it's a mere estimate. It's a mere estimate. It's not an actual cost. It's not an actual outflow of money. There is no payment which is being done for these impairment losses to occur. Then we have the intangible drilling costs. So the intangible drilling costs are also allowable. So these ones are allowable because basically they include the cost of the deepening. When we want to do the mining of oil petroleum products, then we have to do the deepening, we have to do the completing, there is repair, there is the geological cost, the topographical cost, the geographical costs of surveying and all that. So all these intangible drilling costs are normally allowable. Then we have the drilling machine. We have the drilling machine there. The drilling machine is capital expenditure. This is capital expenditure when they acquire the drilling machine. This will be part of the qualifying expenditure. And the treatment for the qualifying expenditure is that we allow only 20% of the qualifying expenditure. We have already identified the first item of qualifying expenditure, which in this case is the acquisition costs, basically the patent rights. So we shall also add the drilling machine to that. Then we take 20% of that as the allowable cost. we have the professional fees. Professional fees, that is allowable. That's the management and professional fees is allowable. And on it, we are given a note number 4, which is saying that there's a professional fees includes 800,000 for services provided by the general manager of the parent company. So again, since the parent company and the Rigs Drilling Limited are going to be treated as separate entities, then we will allow this cost of professional fees which has been allowed by the general manager of the parent company. We will not treat it as one entity for tax purposes. So we shall allow this. We shall treat the general manager as a third party, giving these professional services. Then we have the loan repayment. Loan repayment, that is capital expenditure, so that we shall not allow. We shall ignore that for the purpose of our tax computation. Then we have the cost of the tractor, which is 1.5 there. The cost of the tractor is going to be treated as a capital expenditure, and it will enjoy the normal capital allowances, in this case, the wear and tear allowance, at the rate of 37.5%. We have the derivatives oil losses. So these derivatives of oil losses are the other products, other than the petroleum products, that come together with the oil products. And so we shall allow this. These are normal trading losses, the normal business losses, because they are incurred in the process of doing the business, and we shall allow them. Then we have the restructuring expenses of 848,000, and there is a note 2, which is giving more details about it, saying that the restructuring expenses includes shillings 582,000 paid to a consultancy firm that restructuring the company structure of the company. So that element of restructuring the capital structure is going to be treated as capital expenditure. And so we shall adjust the restructuring expenses of 848,000 by removing the 582,000. We will remove the 582,000. Then we have now the forklift, which was also bought at 1.8 million. The forklift will also enjoy the capital allowances, and in this case, the wear and tear allowance in class 1 at the rate of 37.5%. So basically, that is how we are going to treat the items or the expenditure which was incurred by Rigs Drilling Limited for purpose of arriving at the taxable profit or loss for the year. So our question is November 2015, question number 4. So question number 4 of November 2015. The question requires us to show the statement of the taxable profit or loss for that year. So statement, now we can put the name of the company. The company is Rigs Limited, Rigs Drilling Limited, 2014 taxable income or loss computation. So that is the heading of that. So in this question, the figures are given in thousand for the ease of computation. So the figures will be in thousands for the ease of computation. So we'll start by showing the revenue. So revenue. So we are given that this company has oil and natural gas revenue. So we bring oil and natural gas revenue. The amount in the question is shown as 9,840,000. So 9,840,000. So remember, our figures are in thousands, so these are billions of money, that is the revenue. So on this, we are going to deduct less allowable expenses. Less allowable expenses as per the 9th schedule to the Income Tax Act. That's what I said at the beginning. So we will go through the items first in the additional information, additional information number 1, which is talking about the intangible drilling costs. So we start with intangible drilling costs. So the intangible drilling cost is given as a figure of 3,420. Now we are told that this figure includes, in note number 1, it includes 420,000 for a well which failed to yield crude oil and was abandoned. Now, if a well which is drilled fails to discover any oil, and the costs have been incurred, and these costs have not been allowed elsewhere, then they need to be allowed for tax purposes in the year when they have occurred. So in this case, we are going to allow the full amount of the intangible drilling cost, including the cost of abandoning the well which did not discover any oil. So it is the whole amount. So no adjustment for this case. So we have 3,420. We have 3,420, the whole amount. No adjustment for the abandonment cost. Number 2, we have restructuring expenses. Restructuring expenses. Now the restructuring expenses, it includes 582,000 paid to a consultancy firm that is structuring the capital structure of the company. This, as I have said before, is capital expenditure. The 582,200 is capital expenditure, and therefore it is not allowable. So therefore, we shall adjust that. So restructuring expenditure 848, and we shall subtract the 582. We shall subtract the 582,000. So we have the 848 minus 582, and there we are left with the 266. So 266,000. We are left with 266,000. Then number 3, we have given exploratory drilling costs. That includes what? We are told it includes plant and machinery. It also includes erection of rigs and tankage of 1.6. It includes pipes and storage tanks of 9,480,000. The factory building of 48,400. So these are classified as qualifying expenditure, and they are not allowable in full. We only allow 20% of that. So we then have to adjust that. So we can do some retro workings for the exploratory drilling cost, which is allowable. So exploratory, I can call it working number 1. Working number 1, allowable exploratory drilling cost. Allowable exploratory drilling cost. So the drilling cost. So the drilling cost here is given in the question as 146,400 in thousands. 146,400 in thousands. So on it, we are going to adjust to subtract less the cost of plant and machinery, which is 4.8 million. 4.8 million. No, that's 48. 4.8 million. We are also given erection of rigs and tankage. So rigs and tankage. Rigs and tankage. Now the rigs in this case are the systems that bring the oil from underground to the surface. That is what is referred to as the rigs. So this is 1.6. And then we also have the pipes and storage. Pipes and storage. The pipes and storage is 9,480,000. Then we have the factory building. We have the factory building. The factory building is 48,400. So all these are part of the exploratory drilling cost, and since we only allow 20% of this cost here, we need to adjust for them by subtracting. So all these are for subtracting. So we'll see the total amount after subtracting. So we have 146,400 minus 4,800 minus 1,600 minus 9,480 minus 48,400, giving us a net of 82,120. That is what we are going to transfer to our working as the allowable exploratory drilling cost. So exploratory drilling cost from our working number 1 is therefore 82,120. 82,120. Then from there, number 4 is talking about, note 4 is talking about the professional fees. The professional fees includes 800,000 for services provided by the general manager of the parent company. So we have said for purposes of taxation, Rigs Limited and the parent company will be treated as separate entities. And therefore, the general manager who is giving the service to Rigs Limited is therefore also going to be treated as a third party, and therefore the professional fees that are paid here of 800,000 will be taken to be at the market value and therefore allowable. So professional fees, the total amount given in the question is 2,600, so the whole amount without adjusting. Then, after you have gone through the notes, understood the additional information, we'll go to the figures again, go through them one by one, picking the other items that are allowable, which have not been mentioned in the additional information. So we start from up, and we have geological costs. Geological costs, so we bring them, that is allowable. So geological cost. So the geological cost is 84,680. Exploratory drilling costs, we have already looked at that in our working. Acquisition costs, that we said we shall give 20% of that acquisition cost, because that one will be treated as qualifying expenditure. And normally, the allowable cost of the qualifying cost is 20%. Now, what is the definition of the qualifying cost? Now, the qualifying cost is the cost that is incurred on the acquisition of fixed assets or on the acquisition of the assets. Like, for instance, in note number 3, we have all the assets listed there. The plant and machinery, that's an asset. Rigs and tankage, that's an asset. Pipes and storage tank, that's an asset. Factory building, an asset. The acquisition cost is patent. It's also treated as an asset, and therefore is ended here. So therefore, we can do our working number 2, which will lead us to the qualifying expenditure, so that we can know how much we are going to give here. So qualifying expenditure, Now the qualifying expenditure will form these expenses. We will just pick the same again here. We have the plant and machinery, which was 4,800. We have the rigs and tankage, which is 1,600. So that is qualifying cost. We have the pipes and the storage tanks, which is 9,480. And we have the factory building, which is 48,400. In that cost, then, would pick the other items that are given in the listing here and also are going to be part of the qualifying expenditure so that we can do it once. So in our question, we are saying we have the acquisition costs. Acquisition costs. So the patents in this case, we have 19,800. What else in this question? We have the drilling machines. We have the drilling machines. They are also part of the assets. So drilling machines. The drilling machines are given as 18,300. 18,300. So basically, those ones will form our qualifying expenditure. This is the expenditure on assets. So basically, this is on assets. So we'll take a total of that amount.